This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Dan O'Brien, K-State grain economist, kickstarts today's show with his grain market outlook. He discusses the higher futures prices and if they influenced cash. Continuing the show is a research associate for the Center for Outcomes Research and Epidemiology at K-State, Lucas Horton, as he explains a recent research that looked into extending days on feed of feedlot steers. K-State meteorologist Chip Redmond concludes the show with a weather forecast. He says where in Kansas is likely to see snow in the next week. That and more is coming up ahead on Agriculture Today. You're tuned in to Agriculture Today, and we start our Friday show with a grain market update from K-State grain economist Dan O'Brien. Dan, thanks for joining us once again.
Thank you, Shelby.
Dan, futures have gotten higher, and where are those prices currently at, and what's some historical context with it?
Yeah, we have seen, I would consider it to be an unexpected increase in grain futures from where we were November, December, early January. Again, we were bemoaning the fact that it looked like we'd never see any prices moving to the higher side, but we have. We saw March corn yesterday on February the 6th close at $4.95 and a quarter. It's a far cry from $3.95, and in some of the lower areas where we'd seen prices at. New crop corn, $4.69 and three quarters. And we do have, I guess I'd call it storage carry in the market. From the March 25 to the May 25 contract, you've got an average of about a little over 6 cents a bushel a month in the futures, which for a grain elevator storage charge in a commercial sense, that would cover probably a 6 cents charge. You're probably still not covering any borrowed money, any interest cost on that, which you might want to consider. And for soybeans, saw the March contract close at 10.60 and a half yesterday. May at 10.75, got to November 10.66. So the common theme is that they're all above 10, and again, up about 3.25 cents yesterday, not a lot, but you have carries that are pretty strong still. March contract to May, about 7 5/8 cents per bushel per month. So that's covering storage and interest. Out to July, then you also have about 7 1/8 cents carry. So we're covering on-farm storage pretty handily in most of those cases, even some commercial storage. Of course, that's the market's giving signals that there's still some uncertainty to be dealt with. I would think that if we do see some of the Brazilian record crop size numbers come into play, that some of that carry, it may not be there in the actual closing cash market if we hold all the way out there. So, if someone's storing, it's something to look at. While there's still uncertainty and risk in the market, the market's still accounting for those questions to perhaps do some forward sales to try to capture that carry that's carrying the futures and see where we go. And for wheat, we have wheat. The March contract closed over $6, 607 and a half. Actually, yesterday up 15 cents, but it's been volatile like that, up and down. And we'll get into the reasons in just a minute. May contract 616 and a quarter. So you've got about 4 3/8 cents carry from March to May contract, the same amount then from May to July. We do see new crop July closing at 625. So, you got some issues there to consider. I would say when I look at where we're at right now in the futures prices, that whether a person is optimistic or pessimistic about these depends so much on their reference price, their historical perspective. The 495 that we saw today in the corn market, the lead corn contract, really is in, I guess from a chart point of view, you're coming up to the top of the middle third. in a way, you're getting to the place where when we have had large rallies in the market, basically like happened in 2008, and then again with a short supply and a drought in 2012, all that happened with a short Brazilian crop and Ukraine, Russia in 2022, we got up to these levels where we're at right now, and then had some impetus to shoot us a lot higher. So we're up to almost, in a way, you could call it the point where you either have some impetus, some major move that takes the market a lot higher, or you've reached kind of the top of the middle ground. So it's kind of a precipice, and I'm sure we would love to see the $7 and $8 corn figures that would come in that would really reward people in the cash markets. But we'd have to have some crises someplace else, hopefully somewhere else in the world on the production side, or as we've seen in the Ukraine-Russia situation on the geopolitical demand side, to take us a lot higher. So that's something to keep track of. I would say then for the wheat market, this 607.5. Again, for those that have, we're looking for $7.5 and $8 wheat, et cetera. We certainly have seen those, but again, for the $6 wheat situation, you're again just at the place where major moves start to happen. You're kind of at the top of a generally okay market. So, pretty similar situation there. I would say that the big rally that happened in 2022 and 23, we basically were at this, again, $6 to $6.25 or something in the wheat futures. And from there, then strong market signals came in, as we talked about, Ukraine, Russia, and other issues that really drove us a lot higher. But we got to this point just about here, just over $6 without any of that happening. So that's the question. Do we have something coming that might bring that about? And then for soybean futures, to gain some perspective there, the 1060 is, again, very, very similar. We kind of got to this point and then started jumping about on a per month basis, about $1 or $2 back in the 2021-22 timeframe. So we got to this point, and then, yes, war, drought, whatever came in to bring us a lot higher prices. So I guess they're just a perspective to wrestle with it. If you ask anybody, do they have an economic incentive to wait for better prices? Well, of course they do. It helps their profitability bottom line. But historically, we've had to have major news, major problems to take us a lot higher than where we're at right now. So just thought-provoking. And I guess economists would say, well, what's your reference price? What do you count the current prices as really good opportunities? And what would we need to take them a lot higher? Well, we need something that's a supply shortfall or a demand surge. And so that's at least my perspective at this point.
Are we seeing any of those higher prices when we look at cash?
That's the challenge. Not really. So we've seen some pretty good cash prices right now. That corn has improved. Again, the bellwether market that we try to follow for cash corn in Garden City as a 20-cent over basis. It had been about 10-15 for the top bids in the area. Got up to about $5.15 for corn. Historically, that's pretty good when we're over 5. Other best prices around the countryside in southeast area around the Pittsburgh region, there's a 485 high, 478 Hutchinson, 470 Topeka, 467 Salina, 475 in Colby. So, there's some pretty good bids. The best forward bids for harvest are out in the west. Again, Garden City at 5 over at the Dees contract at 475, even money at 470. The next being about 455 down in the Pittsburgh area. So we're doing, quote, okay. But at these levels, we generally think, we're fully covering our cash costs. We're covering most of our full economic costs. Again, on top of the seed, the fertilizer, and the herbicides, we're covering some machinery and some land costs. But again, the larger profits are above $5 and 5 into 6. So it's we're dancing around the full economic cost level, or coming towards it. I would say for sorghum, those prices are lower. We're coming into the season where if someone has train loads in central Kansas to fill, that's kind of when you see a price spike. In the top bid in Kansas, in the Topeka area, about $445 cash, $435 in both Salina and Hutchinson in those same areas, $435 out in Colby. So $435 is better than something below $4, which is kind of where we were at prior to that. For soybeans, we do have now some forward bids above $10, which again for fall harvest. And that would be in the Salina area, 1001 top bid, 1006 in Hutchinson, 1011 in Pittsburgh. And again, we've talked quite a bit about how the new processing plant in southeast Kansas. It affects some of those forward bids. And I'd say for wheat, we are getting closer to $6 as a forward bid. Best bids, at least that I saw from yesterday's markets, top bid was $5.87 in Hutchinson area, $5.85 both in Salina, Topeka areas, $5.70 in Garden City and Pittsburgh, and then out in Colby, Northwest, about $5.40. So interesting to see how that goes. When you look at the forward bids for soybeans versus corn, and try to see what signals we're giving to Kansas farmers in terms of relative corn versus soybean acres. Again, out in the West, where we have that lot more feedlot pressure, not pressure to the good side, demand. I mean, again, you got ratios for new crop bids of about just a little over 2 in the Garden City, Colby area. Of course, that's favoring corn because we have a lot of corn demand around there. But you're really right on the line of neutrality, or even leaning a little bit soybeans when you talk about Salina, even 230, which is what we're counting as neutral. 2.34% soybeans to corn, Topeka, and 231 at Salina. Interestingly, in that Pittsburgh area, still could be even 2.2, kind of actually leaning a little bit corn. It's kind of surprising given what we talked about soybean market down there. So lots of things going on, Shelby, and some export movement. A pretty good week for corn. Export movement's finally something happening for grain sorghum. A down week. It's been bouncing up and down for the wheat market. And for soybeans, still some decent movement, but seemingly more anticipation now of what's coming in from those South American harvests that will compete pretty strong in the not too distant future against what's happening in the U.S.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but we'll be right back. You're tuned in to Agriculture Today, and we continue our show talking about a recent study titled Extending Days on Feed of Feedlot Steers, Economic Considerations, with Research Associate for Center of Outcomes Research and Epidemiology at K-State, Lucas Horton. Lucas, thanks for joining us today.
Yeah, thank you for having me.
Lucas, why is this study something that you and your colleagues saw as important to do?
Well, for us, our objective was to kind of try and help feedlot producers, as they're always trying to strive towards optimizing endpoint management. A lot of that comes with targeted days on feed, and it's really been an increasing focus in the feedlot industry over recent decades as cattle populations are being fed to heavier and heavier endpoints. So it seems like that optimal endpoint is always a moving target. So there's also been limited economic research in this area, and of the research that there is, it begins to come a little bit outdated as cattle become bigger and bigger. So those studies may not apply as well to today's cattle population, so we wanted to provide the most relevant info on the subject as we could.
What are some concerns for heavier cattle as they continue to get heavier?
Sure. So you can look at it from a couple of different sides. So first, before getting into the economics, even though it's all related, right? But for one, there's just more days at risk for health events to happen, morbidity, mortality, potentially needing to remove or rail cattle. I'm not necessarily saying they're at higher risk of a disease happening, although, there are things like bigger cattle can struggle more in the heat. But certainly there's just, as we feed longer, there's more days where some adverse event can happen. So there's certainly significant economic loss when those things happen. Additionally, there's significant resources that are invested into the animal from the time of conception all the way through harvest, whether that's time, money, blood, sweat, and tears, all of that. So losing an animal late in the finishing period is particularly painful. It's always painful, but losing them, a week before harvest is particularly so. Other concerns, at least for marketing cattle, marketing challenges, or as we feed longer, they're going to have increasing yield grade 4 and 5 discounts, as well as more heavyweight discounts for producers, which most cattle are these days are marketed dressed on some sort of grid. So needing to have the additional weight and quality grade premiums outweigh those carcass discounts can be a concern. Additionally, kind of another economic consideration is opportunity cost. So what this can imply, or how we considered it, there's a lot of ways to consider opportunity cost, but how we considered it is there's a cost of delaying when I receive my revenue, right, or when I get paid. So if I market my cattle today, I can get paid today, then that money can accrue interest, I can use it to pay off operating loans, do other things. So there is kind of a discount or penalty for waiting to receive revenue later. Additionally, there's risk of price changes. So as we know, cattle prices, markets, they're always fluctuating. So potentially receiving lower prices when I decide to market my cattle later at a heavier weight could be a challenge as well.
How did you guys set up this study?
So this study used information from a recent commercial feedlot trial to evaluate kind of the cattle biological considerations, so gain, growth, changes in quality and yield grades, those potential health events, and then we also used industry-reported data for our economic considerations. And essentially what we did, our objective was to evaluate the economic risk of feeding contemporary feedlot steer populations longer than the current industry standard. And here, economic risk can come from a few different things. That can come from biological variability. Not every pen of cattle is going to grow the same, have the same health risks, right, due to breed, management factors, those sorts of things. Also, we have economic variability with market fluctuations that goes without saying. So basically, we use those data sources to simulate a variety of animal conditions that occur when feeding longer, as well as those combined with a variety of economic conditions, basically to see how often net returns were positive or negative compared to the industry standard when feeding longer. So basically, was it advantageous to add days on feed or not?
What did you find?
So there were a few key findings. Number one, which is I think more or less what we expected, is that net return variability increased as feeding longer, or when we fed longer. So I think that makes sense. Like we said, as we feed longer, there's more biological variations or things to the pen that can happen. There's also more potential for market fluctuation. So the further out we go, there's more uncertainty. So we did see a potential for improved net returns the longer that we fed cattle. The highest possible net returns were achieved by feeding cattle for the longest extent of time beyond the industry standard. However, overall, negative net returns were more frequent when feeding beyond the industry standards. So with that potential benefit, that came with a risk of even greater losses. And on average, we saw that we didn't have a lot of evidence of feeding beyond current industry standards. One point I want to make with that is I'm not necessarily saying that the industry has gone too far, that we've pushed cattle too far. We didn't evaluate that. We were looking at with where we currently are, going further than we are today. Again, there was potential benefit, but overall it seemed like it was not consistently advantageous to feed beyond the industry standard. When grid marketing, those losses were primarily driven by the yield grade and heavyweight discounts. So we were seeing that more often than not, the added weight and quality grade premiums were not outweighing the heavyweight discounts. So after all that, we did a kind of a secondary analysis to try and see what were the most influential factors that kind of drove those changes. So were they economic factors? Were they animal performance factors, like how much the cattle were gaining, eating, etc.? And basically what we saw is the top factors were all economic. So number one was just fed cattle price changes. So if I receive a higher price by waiting 2 weeks, then if I market them today, that's maybe a reason to add days on feed. If prices become lower, then that would disincentivize days on feed. Obviously, I can't always know when that's going to happen, but that was the number one factor. After that was just what the base cattle price was, corn price, what the quality grade grid was. Was it incentivizing higher quality grades, or what level quality grades were being incentivized to? And the most important animal characteristic was the number of mortalities. So in this data set, there weren't a lot of simulated mortalities, but when they did happen, they were certainly important and a big driver of net returns.
What are a few key points that you'd really like Kansas cattle producers to remember from this study?
So I think first and foremost, I would say to prioritize economic conditions when we're making marketing and endpoint management decisions. Certainly visual assessments of weight, how fat the cattle are, their degree of finish, how we expect the cattle to grade, all that's important. But what we may consider as the optimal biological endpoint for a pen of cattle based on some of those factors, that may not always align with what's the optimal economic endpoint, which is likely a moving target based on those fluctuating conditions. So certainly use what resources we have. There's no model that can perfectly predict cattle price changes, but if prices are trending up, that's probably going to incentivize longer feeding. So looking at futures prices, seasonal trends can help with that. But importantly, those should always be incorporated with appropriate risk management practices, which I'm probably not the guy to talk to you about that. There's a lot more qualified folks at K-State to talk to you about risk management, but certainly that should be incorporated.
Lucas, if people want to find out more information about this study, how can they do that?
There's a few ways. Any of the authors on the publication would be more than happy to help. You can reach out to me by email.
Lucas, I appreciate you taking the time to join us today.
Oh, thank you for having me. Appreciate it.
That was Research Associate for Center for Outcomes Research and Epidemiology at K-State, Lucas Horton. I will link this research publication in today's show notes on agtoday.net, as well as place Lucas's email. We're cutting to a short break now on Agriculture Today, but we'll be right back. You're tuned in to Agriculture Today, and we end our Friday show with a weather update from K-State meteorologist Chip Redmond. Chip, thanks for joining us today.
You end it with the best. Good morning.
Chip, this past week we saw some precipitation, and what were some positives with that?
Yeah, when we recorded last week, we were kind of in the middle of a precipitation event that was ongoing, and we had some pretty impressive rain totals at the end of that. Rain, when we think about February, rain isn't necessarily the first thing on our mind, but we had a lot of it, and we had some lightning, and we had some moderate rates of rain, especially in further north and east of Manhattan, where they had totals getting close to the 2-inch mark. I know 1.5 inches was pretty common around most of the Kansas City area. As you came further west, it dwindled off. Manhattan area got around an inch, give or take. And as you got west from Manhattan and south, the precipitation amounts dropped off rapidly to almost nothing, really, from that whole event. Precipitation was interesting because, like I mentioned, it fell at a moderate intensity for this time of the year. It wasn't thunderstorms, but just widespread, persistent, moderate rain is pretty unusual for February. But additionally, we still had that frozen soil in a lot of places, and we had snowpack at that time. We were on the back end of that snowpack. It was diminishing pretty quickly, and that rain actually helped move that process along a little bit. But we had more runoff as a result. And I know some places saw their localized creeks rapidly rise as a result. And thankfully, it was spread out over a decent amount of time. It wasn't a heavier rain event, or else you could have potentially saw flash flooding. But regardless, that's in the rearview mirror. Since then, we've dried out quite a bit. and we have had periods of clouds and fog and now sunshine to end the week on a good note. But we've gone through some pretty impressive temperature swings as a result of these kind of changing air masses where we ebb and flow right along that jet stream right now. We saw temperatures skyrocket. Southwest Kansas hit 86 degrees on Monday. 24 hours later, they were 30. And so some big temperature fluctuations with the result of that drier air in place, and also a result of some impressive cold fronts as that cold air up north that's been building there for the last several weeks is starting to work its way south, pushes of cold air to the south, not one big movement. And so we see warm air briefly rebound right now when temperatures are definitely moderate a little bit compared to the cooler temperatures we saw on Tuesday.
Are we going to see some snowy precipitation as we move into next week?
Yeah, so as we move forward in the forecast, this weekend at least looks pretty seasonable. Temperatures will be in the mid-40s to near 50 degrees, with overnight lows in the 20-degree range. Pretty normal for this time of year, maybe a skosh above normal, but overall sunny skies, but dry conditions. As we move into next week, this is when that jet stream really starts to become more turbulent. We see a big push of cold air from the northwest, and a much stronger storm system is going to track through Oklahoma and then off into the Ohio Valley. But what that system is going to do is it's going to pull that colder air southward and drag that jet stream south. We'll see that cooler air move in. That'll allow for any precipitation that does fall next week to potentially be of the frozen variety. Temperature-wise, we're looking at highs, potentially the coldest days, Tuesday, Wednesday, in the 20s, and lows potentially in the single digits to near zero. Just a couple of day period, but overall, all of next week looks below normal. And with those storm patterns still being pretty active, any moisture we get is going to capitalize on that colder air, and we'll potentially see some snow. Honestly, I think the probability of everyone seeing snow next week is pretty high because we've got that first system that comes through on Tuesday, and then we've got 3 or 4 more weak systems that are going to move through that pattern and through that jet stream that's just to our south, and that'll provide just enough moisture to keep waves of snow moving through the state. It's possible we could see snow every day next week in Kansas. Probably not in the same place each day, but overall I expect everyone to get some snow to some extent, with the areas that get the most frequent events to be eastern Kansas, especially probably Monday night into Tuesday, and then again Wednesday night into Thursday. And the totals could probably exceed 3 or 4 inches, maybe even 5 inches of snow when we're all said and done by the end of the week. And honestly, that cold is really the short-lived event. We're not looking at multi-week, super cold Arctic air. We should warm back up by the end of next week, and we'll be melting that snow, I'm going to guess, a lot quicker than we did the last time.
That was K-State meteorologist Chip Redmond. That's all we have for you today on Agriculture Today, but we'll be back with more for you on Monday.